Hello, I wanted to give you the update for the growth account activity in November. I want you to remember we use these videos because they're a convenient way to get you up to date information quickly. It keeps you well informed. You get to watch it at your own convenience. And as a reminder, we're always here for a personal one on one discussion, but this way I can get it out to you. So, here's what's going on. First, as of November 1st, for the month of November, the market continues to show the strength. We talked about seasonality before. It's almost like the clock turned, and all of a sudden, the August, September, October decline, lousy market changed, and we started to take off. So this month, I've reduced the cash reserves even more. The seasonality is now we are in a strong quarter. The November, December, January quarter is normally very strong. And what we're simply doing is using historical analysis for tactical positioning. So, you saw this chart from before, and before you see the two red lines, and that was where we were, and now look, we're now here, and look where the market starts to take over. And if you look to the far right, you'll see those last 3 months were weak. November and December are historically very strong. So here is what is driving it. First of all, the Fed has signaled that we have a probable peak in the interest rate cycle. Yes, they say there may be one more possible increase on the table. They always leave that open. But overwhelmingly, it appears that this massive move over the last year, which has caused all the damage, is over with. Second, inflation. Inflation reports continue to confirm that disinflationary trends are in many commodities. The easiest way to see it directly is go fill up your car. Last year we were over $4 a gallon. Now we're in many cases we're $2 and change. So you're seeing that across the board. You've seen it in coffee, you've seen it in lumber, you've seen it in wheat, you've seen it, and actually you've seen it in housing prices. Although there are a few strong points around the country, South Florida being one of them, housing and rent prices around the country are actually starting to move down. Now, so far in November, 94% of the S&P 500 have reported their earnings, and 82% of them beat the estimates. We're also now seeing a resumption of corporate buyback activity. That supports the market. The market knows when stocks go down, if corporate activity is there, they buy stock anytime it declines. And as I already said, we have this positive seasonality play. So, the silver linings we talked about before. The Fed has been successful in reducing and slowing down inflation. We're not going to go back to the pre-pandemic prices, but we're not going up 9% annually as we were back in June of last year. You're going to hear more and more discussions about a soft landing. A month ago, no one said very few, I should say, actually said a soft landing was possible. Now, you're seeing it across the board. They're saying a soft landing, which simply means the economy slows down without going into a recession. The latest development we're seeing is artificial intelligence. More and more companies are harnessing artificial intelligence for increased productivity. That goes right to the bottom line. And I'm looking for some unexpected positive market surprises. Next, I always hammer on this perspective. For anything to have value, it has to be put in perspective. Your team scored 21 points. Did they win or lose? If you don't know the other side, you have no way of knowing. You have to have another number to compare it to. All right, remember 2020, COVID. The market went down 35% in 6 weeks. Yet for the year, it ended up over 16%. So recently, we went through 2 very bad years, very close together. 2022 was COVID, shut down the world's economies everywhere. Hold on, what? Oh, I'm sorry. Yes, 2020. I'm sorry, I said 2020. In 2020, we had COVID. 2022. Remember this, the Fed increased interest rates in 1 year 20-fold. They went from a quarter of a point to over 5.5%. That is the sharpest rise in rates since 1980-81 with Paul Volcker and Jimmy Carter. Wow. So I also went back for the last 50 years. You may have seen this before, but I wanted to reemphasize it because it's so important. And what I'm looking for is how many back-to-back years? 2022 was a terrible year. How many back-to-back years do we have? Well, I had to go back 50 years to find two back-to-back years. 2000 to 2002, the dot-com bubble, and then also 73, 74, the Arab oil embargo. And what was really the economic hit in that was the Arab oil embargo, not just what was happening in the market. Remember, 73, 74, 40% of our oil was imported. Today's situation is completely different. We are now the world's largest exporter. We're ahead of OPEC and we're ahead of Russia. And by the way, Texas, if it were a country, Texas might think it's a country, but if Texas were a country, it would be the fourth largest oil producer in the world. So the situation today, very, very different from the 73, 74. Now watch this. I go back 10 years. There is not a single back-to-back negative years. And if you look up there, we got 10 years, 3 down, 1 very modest. So I got 70% up. All right, so now let's try the last 20 years. The same thing. I don't have any back-to-back years. I've sort of got a mild year. That 2008, that big decline was the banking and real estate crisis. We're nowhere near that level of intensity of an economic problem. 30 years, I still don't find two back-to-back, but at least now you see the effect of the dot-com bubble. And that was the 2000, 2001, and 02. Now, to get back to find two back-to-back years, look at this. I've got to go back 51 years to be exact, because it was back in, when was 1970, when we had the big rise in rates, and then 2000 to 03, or 2000 to 02, the dot-com bubble. And during all that time, for every one of these, I'm going to go back and just make a point. 10 years, 70% of the time the market's up, 7 out of 10. 20 years, 6 out of 20, same, I'm at 69%. 51 years, it's still a ratio of 69%, 7 out of 10 years are up. My conclusion is the worst of the storm is over. I want you to remember this. It's very important. The issue causing the most damage, the Fed raising rates so quickly and so much, has come to an end. I think it's come to an end. Many say there might be another raise, but overwhelmingly, we're done. As Janet Yellen said, the creation of 500,000 jobs is historically not associated with a recession. So, those who learn from history, those who do not learn to history are doomed to repeat it, and those that do learn from history can prosper. Drawing from historical parallels, now, I believe, is a very opportune time to re-enter the market, which is what I did in the growth accounts in November. So, also want you to remember this, the news. The news is not in the business to make you a better investor or to keep you better informed. Think about this. The purpose of the news is to sell advertising. They want you to watch. That's what you hear the term clickbait. That's what that's all about. Media's inclination is overwhelmingly towards negative news. Why? Negative news sells. It just brings in more viewers. So embrace the reality. It's going to be negative news all the time. Pretty soon you're going to hear, oh my God, is it too late to get back in? No, I believe we're beginning another bull market leg that's going to last, I'm going to say 2 to 5 years, but we'll play this by ear. So, finding the actual bottom is very elusive. I'm going to tell you, I believe we found it. We remain vigilant in the market performance all the time, because remember, we don't make predictions, we make observation. And my observation is we're ready for a new leg of a new bull market. And the recent market performance suggests this strength will continue. We are postured now to take advantage of any of these turns. So, our portfolios, they focus on high quality companies with robust earnings, significant sales, and successful products and services. And we're adhering to the principle that patience often rewards yields. And remember, the historical insights from 1957 to 2022 was an average just exceeding 10%. So, patience, we weathered the tough periods. We recognize there were temptations to get out, but a simple rule that you've heard before: be fearful when others are greedy, and be greedy when others are fearful. There's still fear out there, and I think now is a very good time to get in the market, and it does pace your patience. Okay, that's really what we're done. You know this, we maintain high quality companies. We're trying to keep you informed. We leverage our experience, and you've heard many times we're here looking out for you, and that's it. By the way, if you have any other questions, I'll just give you a couple other things. We're doing estate planning webinars, taxes and retirement, navigating Social Security, savvy IRA planning, and we've got one coming out is how to protect your children from their inheritance. All right, thank you very much, and always remember, we're here looking out for you.